Hey folks, I'm here back with another macro metrics dashboard video because the property and stock market is not an indicator of economic health. Now, in the last video, if you haven't already seen the first one, it's essential viewing. Just go to my YouTube channel, so just go to YouTube, type Siam Kid in, find my channel, and there it is. It's macro metrics, this one here. It's a long one, but it's the base knowledge that you need. And we covered quite a lot, basically, that the main health indicators are this lot over here and not the central bank levers. And what I'm going to do is simply update you as time goes by, and we have a massive bombshell today. So make sure to like, subscribe and all that sort of malarkey, and let's get into it. Righty-tighty, so we're not going to go through all of the different health indicators today, but I just want to look at this one here, delinquencies and bankruptcies. So I should also add plus bailouts, because we have had some huge bailouts. So we talked about all of this last time, so where's the big red line? Here we go. So you've probably already seen lots of news articles relatively recently about big Fed bailouts, and that the Federal Reserve, the central bank of the US, is simply propping up all markets pretty much. And they started buying up loads of ETFs. So if we scroll down here, you can see basically these are all the ETF sellers, so i.e. the main primary lenders, the big banks, and they're basically giving huge amounts of money to the banks, which we all know. I mean, it's a revolving door. We call it government sacks. Most of the head of the US Treasury tends to be an ex-CEO of one of these banks, so they're just looking after their mates. And I guess they're trying to do trickle-down economy, but it doesn't work. All the capital, the liquidity lines, the currency printing just gets absorbed by the elite, the billionaires, the big corporations, and us mere plebs never really touch it. And that's why I'm still bullish with stocks in the short term, even though I'm massively bearish in the long term, because they're buying up all of the ETFs, and a lot of them are S&P 500 type trackers. So if we look at, if we get, here we go, S&P 500, let's look at the daily charts. So it's absolutely no surprise we've had this massive stimulus pump, because they're simply propping it up, and it looks like it's just caterpillaring up these support levels. So we should see a bounce moving forward in the short term. So a couple of weeks ago, about 2 weeks ago, the Fed said it's going to start buying individual corporate bonds. So for those of you unfamiliar, now this is huge. Now forget that it's CNBC, there's loads of different places that said this. And so what I've been doing is keeping an eye on which companies are they effectively bailing out. Now, so for those of you who are unfamiliar with a bond, so every time you hear the word bond from now on, let's just get the pen out. A bond is simply an IOU. So if someone buys one of your bonds, so let's say you have a company, and that is your LTD here, you can issue a corporate bond. So a corporate bond, a company bond, let's keep things simple. So you can issue your own, let's call your company Awesome Limited, so A Limited. And so you can issue an A Limited or an A bond with a 5% coupon. And what this basically means is that whoever buys your bond, however much it may be, they simply, you will simply pay an interest, call it interest or an ROI of 5% per year. So that's basically it. So a corporate bond is a company trying to borrow money via debt. They're taking out a loan. And they're going to pay 3, 5 or whatever percent. So that's basically what it is. So ever since that news article, I've been trying to keep track on which companies they're effectively bailing out, because that's pretty much what this is. This is big, this is money that the Federal Reserve is plucking out of their arse, and they're simply giving it to other billionaires. So if you have a look at this one, so this is what I've been keeping an eye on. The secondary market corporate credit facility. So long story short, if you're ever bored, click this, click the top one, and then down here I've been going through all their PDFs, and then we got this bad boy here on the 28th of June. Not that one, it's this one here, this spreadsheet. So if you click this, and then download. You can see I've already downloaded it, but and then open it up. It's a treasure trove. It really is, for a geek like me at least. So let's just go through all of the different tabs very quickly. So they've said that they're going to bail, or they're buying corporate debt of 750 companies. So this is just a small portion, but look at this: AT&T, ACTIVISION, that's COD, Call of Duty, Berkshire Hathaway. Berkshire has over $130 billion in cash, just literally liquid cash. Yet they're giving out loans to Berkshire, Boeing, CVS, Caterpillar, Chevron, COCA-COLA, any other big ones here? EXXON, MOBIL, FEDEX, Ford, General Motors. What else is there? HP, Home Depot, Honeywell, Hyatt Hotels, IBM, Marriott. Don't know what Medtronic is. PepsiCo, PayPal, UPS, Cisco, and Walmart. Jesus, it's absolutely nuts. Now, this is the beginning. So at the moment, the amounts aren't that much. So let's take I don't know, COD or Activision. So they're basically paying 2.6%, and they've effectively got a $1.5 million loan. So it's not that much. So all of these companies, they're not getting that much. So Coca-Cola, $6 million, but it's money there for the taking, just like a bounce back loan. If a company sees troubled waters ahead, it's worth getting in cash and getting some sort of war chest so you can navigate it. So it's cheap money. It's pretty much cheap money. I mean, look at this Caterpillar. They're paying less than 1%. Obviously, the maturity date is different, but when you add all these up, if we just auto sum that, at the moment it's only $207 million. That's chump change for the Fed. But just watch this increase. So here, here's the ETF one. So this is basically all the exchange traded funds. So this is the Fed literally propping up the stock market. So they're buying all of these trackers, and lots of them are S&P 500 trackers. And so so when you add all of this up, that's about $6.8 billion. $6.8 billion, which is just nuts. And when you look at who owns all of this, where is it? It's here somewhere. It's basically BlackRock and Vanguard, etc. So yeah, this is nuts. This is absolutely huge. So the economy isn't. They wouldn't be doing this if the economy was healthy. Okay, so this is what's going behind the news, and you'll never see this in the news. So hopefully that makes sense. And I'll see you soon. Toodles. Bye bye.